All right, let's dive right into a topic that is absolutely critical for the bar exam: financial valuation decision models. And look, this isn't just some abstract theory. This is the real world playbook that companies use to make huge, multi-million dollar investment decisions. If you can master this, you're not just passing an exam, you're understanding how businesses actually create value. So, picture this. You're a company, you've got a pile of cash ready to invest, and you've got options. Should you launch that shiny new product line? Or maybe upgrade the factory? Problem is, you can't do both. So, how do you pick the winner? How can you be sure which project is actually going to make the company richer? That is the exact question these financial models are designed to answer. But before we can even start to compare projects, we have to get one concept down cold. It is, without a doubt, the single most important idea in all of finance. And for the exam, it's totally non-negotiable. I'm talking about the time value of money. Seriously, every single model we're about to look at is built right on top of this one idea. So what is the time value of money? Well, it's actually a pretty simple, almost obvious idea. A dollar in your hand today is worth more than a dollar you're promised next year. And why is that? It's all about opportunity. You can take that dollar today, invest it, and it can start earning you more money right away. A dollar you get in the future, it just sits there, missing out on all that potential growth. And this leads us to something we absolutely have to do. To make a fair comparison between money we spend today and money we hope to get back years from now, we can't just add it all up. That's like comparing apples and oranges. We have to translate all those future dollars into a common language, what they're worth right now, in today's terms. And that process has a name. It's called discounting. We're just bringing future value back to the present. So the big question is, what rate do we use to discount those future dollars? Now, here's a heads up for the exam. They love to use different terms for the exact same thing. You might see it called the discount rate, the hurdle rate, or the required rate of return. Don't let it trip you up. They all mean the same thing. It's the absolute minimum return a company needs to earn on a project to make it worth their while, considering the risk involved. Okay, so with that foundation in place, let's build up to the most powerful tool in your entire capital budgeting toolkit. This is the one you really need to know inside and out: net present value, or NPV. For the exam, and frankly, in the real world, NPV is the gold standard. You get this, and you're way ahead of the curve. What NPV does is answer one very simple, very powerful question. In today's dollars, how much richer will this project make the company? That's it. It takes all the cash you expect to get back, discounts it to the present, and then subtracts what you have to pay up front. The result is the net value created. And here is the formula you have to burn into your memory. Net present value equals the present value of cash inflows minus the initial investment. It's that straightforward. Now, remember, that initial investment is already a present value because it's happening today. The real work, the part where we use our discount rate, is in figuring out the present value of all those future earnings. Okay, let's make this real with a quick example. Let's say a project costs $120,000 upfront. In return, it's projected to bring in $35,000 a year for 5 years, and the company's required rate of return, our hurdle rate, is 8%. Now, for the exam, they won't always make you do the heavy lifting of discounting. Often, like here, they'll just give you the total present value of those inflows, which in this case is $139,800. So we just plug our numbers into that simple formula. We take the present value of the inflows, $139,800, and we subtract the initial cost, $120,000. And that gives us a net present value of $19,800. So we have our number, $19,800. It's a positive number? Great. But what does that actually tell us? What's the final call here? Does the company go ahead and pull the trigger on this investment? This is the best part, because the NPV decision rule is incredibly simple and powerful. If the NPV is greater than 0, you accept the project. Period. A positive NPV literally means the project is expected to create wealth for the company, above and beyond its required rate of return. So in our case, it's a definite yes. We accept, because this project is projected to add $19,800 of pure value to the firm in today's money. Oh, and just a heads up, on the exam you might see some messier numbers, but the process, the logic, is exactly the same. Okay, now even though NPE is king, you can't just ignore the other tools in the toolkit. The exam will expect you to know a few other valuation models. And what's really important here is not just knowing what they do, but understanding their limitations, because that's where the tricky questions come from.
First up, we've got the internal rate of return, or IRR. Now, if NPV asks, how much value do we get, IRR asks a slightly different question. It asks, what is this project's true, built-in rate of return? It's the unique discount rate where the project perfectly breaks even, where the present value of what you get back exactly equals your initial investment, making the NPV exactly zero. The decision rule for IRR is just a simple comparison. It's like a race. Let's say our project has an IRR of 12%. That's the project's speed. Then we look at our company's required return, our hurdle rate, which is 10%. That's the speed we need to beat. So does the project clear the hurdle? Yes, 12% is greater than 10%, so we accept the project. It's generating a return higher than our minimum requirement. Next stop is probably the simplest method of all, the payback period. This one doesn't mess around with complicated formulas. It asks just one very direct question. How fast do I get my initial investment back? That's it. It's not really a measure of profitability. It's all about speed, liquidity, and risk. A company that's short on cash might really care about this. All right, sirens on for this one, because this is a classic exam trap. The simple payback period has two gigantic fatal flaws you've got to know. First, it totally ignores the time value of money. It treats $1 you get 3 years from now the same as $1 you get tomorrow, which we know is wrong. Second, it completely ignores any and all cash flows that happen after you get your money back. A project could become a gold mine in year 4, but the payback method is blind to it. Now, there is a slightly better version called the discounted payback period that fixes the first problem, but even it still ignores all that money coming in later. And finally, let's talk about the Profitability Index, or PI. The formula is just the present value of your future inflows divided by your initial investment. Think of it as your bang for your buck ratio. It tells you for every $1 you invest today, how many dollars of present value you get back. The decision rule? Super easy. If the PI is greater than 1, you accept it. A PI of, say, 1.2 means for every dollar you put in, you're getting back $1.20 in today's value. It's really useful for ranking projects when your budget is tight. Okay, so we've got NPV, IRR, payback, and PI. It's a whole toolkit of metrics. So how do we pull this all together into a solid, repeatable decision framework that you can use to just crush these questions on exam day? Let's build that game plan right now. First things first, you have to know what kind of choice you're making. If the projects are independent, meaning you can pick one or both or neither, the rule is easy. You accept every single project that has a positive NPV. But if the projects are mutually exclusive, like our new product or factory upgrade scenario, you can only pick one winner. In that case, you find the project with the highest positive NPV. So here it is, your step-by-step thinking framework. 1, lay out the cash flows, what you pay, what you get back. 2, lock in the right discount rate. 3, calculate the net present value. This is your number 1 priority. 4, apply the rule. Is it positive? Is it a go? 5, if the question requires it, look at IRR or PI as backup answers, maybe for ranking. And finally, step 6, make the final call based on whether the projects are independent or mutually exclusive. This really puts it all in perspective. NPV is at the top of the pyramid. Its strength is that it gives you the answer in cold, hard dollars. For exam purposes, it's basically flawless. Now, IRR, people like it because a percentage feels intuitive. But here is the giant exam trap. IRR can sometimes point you in the wrong direction. Why? Because it makes an unrealistic assumption that you can reinvest all the project's cash flows at the super high IRR itself, which often isn't possible. And that's what can cause it to clash with NPV. And that brings us to the ultimate tiebreaker, the golden rule you absolutely must remember for the exam. On the rare occasion that IRR and NPV give you conflicting answers on mutually exclusive projects, who wins? The answer is NPV, always. The decision should always be based on the project with the highest net present value. It is, hands down, the most reliable measure of how much wealth a project will create. So I'll leave you with this one last question to really lock it all in. When the pressure's on and the board asks, forget the percentages and the payback times, which one of these projects is going to make our shareholders the richest? Which single number gives you the cleanest, most direct, most reliable answer? You know it. It's the net present value. Master that, and you're in great shape. Now go crush those studies.